Welcome options traders, and I wanted to post a video here on what I think is a really interesting topic of vertical spreads when early exercise can help or harm. And I chose this for really one key reason. It's going to target two specific groups that we have in this forum here, where you have a lot of people who are experienced traders who may actually be using vertical spreads, but we also have a lot of brand new people who may have never even heard of a vertical spread. But regardless, both people will get something out of this video. The people who are experienced will obviously get some nice tips on vertical spreads. But just as important for people who are brand new and may not understand a lot of the topics I'm going to be talking about in here, will at least get the underlying message. And that is, you have to have good options training in order to succeed with your investing, because there's just too many things you don't even know that you don't know. And when you do that, it can cause you to either miss opportunities or potentially step into traps. So let's take a look at vertical spreads when early exercise can help or harm. Let's start with a couple little definitions. First of all, exercise versus assign. If you own an option, you are the long option. And long option holders have the right, not the obligation, to exercise their option. But that means you had to have purchased it. So if you buy a call option, you have the right to buy 100 shares for the strike price. If you bought a put option, you have the right to sell 100 shares and receive the strike price. But in both cases, it is a right to do something. On the other hand, if you sell an option, or what we call the short position, you have an obligation. And short option holders may get assigned. That's the term that we use in the industry. We actually don't say, I got exercised, even though a lot of people will say that. The term is we got assigned. However, you cannot command an assignment. You can't call up your broker and say, hey, I think I'd like to get assigned on my short option now. The only way you get assigned is if the long position decides to exercise. So let's say you've got a short call and you get assigned. That means you are going to be required, it's an obligation, to sell 100 shares and you will receive the strike price. On the other hand, if you have a short put and you get assigned, you will be required to buy 100 shares of stock for the strike price. So once again, notice that you're either going to be a buyer or a seller, just as with the long positions. These are flipped though. The short call might end up selling, the short put might end up buying. But the only way that you do that with short positions is if you get assigned. Now I know it can be tricky to understand, so let me show you a nice little table that will help you to figure these out. Just draw a little matrix like this, put your buyers and sellers on the left, calls and puts on the top. Start off with the things you know. The call buyer has the right to buy, and the put buyer has the right to sell. That's fairly straightforward for most people. But what about the sellers? What about the short options? Just flip it around. They're on the opposite side of the trade after all. So the call seller has the obligation to sell. Notice that the opposite of right is obligation, and the opposite of buy is sell. It's the only way the contract can work. What is the obligation of the put seller? Well, if the put buyer has the right to sell, just flip it around. Put seller has the obligation to buy. And once again, we see the opposite of right is obligation and opposite of sell is buy. So always start out with what you know. The call and put buyer, and once you've got that figured out, the call and put seller are just on the opposite side of the trade. Now, keeping those terms in mind, let's take a look at a strategy called a vertical spread. My goal is not really to go into details on the vertical spread here, although I do it in the Alpha Trader course and in the strategy lab. But let's take a look at some of the basics. With a vertical spread, you are going to be long one option. So let's say you go out and you buy a call option. And then you will be short another option at a different strike. Now, both of these options have to be the same type. That means they both have to be calls or they both have to be puts, not one of each. They must also have the same expiration. So for example, let's say that we buy the May 50 call and we sell the May 55 call. That is a vertical spread. And let's say that we bought this spread for a net of 3. Why do we say a net of 3? Well, it depends on what the individual option prices were. Maybe I paid $8 for the $50 call, but I received $5 from selling the May 55. The net difference between those is 3. And so in this example, we'd say I've got a net debit of 3. So this is the profit and loss diagram for a vertical spread, at least for the call spread that we just looked at. And the first thing you can see once you understand profit and loss diagrams, is that the stock price needs to rise in order to get us into winning territory here. This is where the profits lie. Okay, we need the stock price to rise. So I can tell that this is a bullish position, and it is in fact called a bull spread. On the other hand, if the stock price should fall out in this direction, we head into losses, although limited losses. And in this example, we assume that we paid 3, so that would be the most we could ever lose. But now think about this. In that example, we were long the 50 call, and we were short the 55 call. So if we have the right to buy shares at 50 and the obligation to sell shares at 55, the most we could ever make is the $5 difference in strikes. And that will always be true for vertical spreads. So if I paid $3 for the spread, and the most I could ever have this spread be worth is 5, then that means my maximum gain must be 2. But now the question that we want to address for this video is to say, we're in this position, and suddenly we get assigned early. And that just means you wake up one day, you look in your platform, and it says you've got a notification from the OCC that you sold 100 shares of stock because you got assigned on this 55 call. We're not at expiration yet, and it's really not advantageous for the option buyer to exercise early, but for some reason somebody did. What's going to happen now? Well, again, we look at our platform and it shows that we're now short 100 shares of stock, and here we are long our $50 call. I've now got 2 positions in the account. And if I look over in cash, it's going to show that I've been credited with $5,500 cash. Where did that come from? Because when the option buyer bought it, he paid $55 for that contract. He was the long position, we were short. So that means we received $5,500 cash. And this is where most traders panic and they go, oh my gosh, I've got a short stock position in here. Let me exercise my call. Maybe the stock is at 57 or 58. I don't want to go pay market price. I'll just exercise my call. Where will I get the $5,000 from? Well, I just got credited $5,500. So let's go take $5,000 from there. We'll exercise our call, which is just as simple as pushing a button on your platform and saying, yes, I want to exercise it. And when you exercise it, that $50 call goes away. You don't get to sell a call and exercise it. You get one or the other. So once we exercise it, it just vanishes from the account. Now the next day, when the exercise actually goes through, we will be long 100 shares of stock. But look what we have. We're short 100 shares, we're long 100 shares. They flatten out. And so when it's all said and done, we are just holding $500 cash, the maximum we could have ever made anyway from the vertical spread. However, we got paid early. It was never a problem. And it doesn't matter if the stock is trading for 55 or 70 or 100 or 10,000. We can always exercise it for 50 and end up with the $500 cash. But because we ended up in a good position early, that's another way of showing it's not advantageous for the call buyer who actually exercised early to do so. It was a big benefit to us. But as a professional trader, what would you know to do? Let's go back to when we log into our account here and see that we're short 100 shares and long this 50 call. If you understand synthetics, and if you don't, there's another video in here called Synthetic Options that will fully explain it. I can look at that and tell that is the same thing as a $50 put. The combination of short 100 shares and long the 50 call is exactly the same thing mathematically as holding a $50 put. And that means that my profit and loss diagram has now shifted to this. Maximum that I can lose is right here at 3. Why? Because that's the maximum that I had in the vertical spread. I've just put $3 out, no more cash. However, notice that I can now make an unlimited amount if the stock price falls. See, I didn't have that before. If we compare the vertical spread with my new synthetic position of this put, I had a limited gain with the vertical spread. Yes, the stock needed to go up for that, but it was still limited. But with the put, it's unlimited. And yes, I need the stock to go down. But even if my outlook is bullish, I'm going to keep the synthetic put. Why? Because it can only help me, it cannot harm me. In other words, I might do better if the stock does turn around and fall, even though that's not my outlook. Keep it like a lottery ticket. Maybe it'll happen. In which case I can make more than 5. But what if it never happens? What if the stock goes up to 100? Fine, exercise your 50 call and take the 500 cash. It's exactly what would have happened if you had done that today. But just wait. You might do better, but you can't do worse. And I know that because I understand my synthetics. However, when could that same situation actually harm you? And this is why it's important to understand all of these nuances. Because a lot of people have been trading vertical spreads, and I've worked with traders and they go, I've never heard of this. Nobody's ever told me this before. But there's a special case when you have an American-style cash-settled index, such as the OEX, the S&P 100. Let's say you have the 1200-1210 vertical spread. You're long the 1200 call, you're short the 1210. The difference here is that if you get assigned on that 1210, you don't owe shares of stock. You owe cash, specifically the difference between the index at the time you get the assignment and the strike that you're holding. So for example, let's say if the index is 1220 when we got assigned, and we're short those 1210s, so we owe the 10-point difference, or $1,000 cash. Now just to make things a little more dramatic, let's say we've got 10 vertical spreads and we actually owe $10,000. Well, normally we'd think, no big deal. I'll just exercise my 1200s and I'll get $20,000. I'll pay the $10,000 and I've got my $10,000 difference. Exactly what we just talked about for the stock. But we actually have a risk here. And that's because we're not dealing with shares of stock. See, if the stock market falls, obviously the stock price drops too. That's what made the synthetic put work. But here, if the index falls, the price of cash doesn't change. We still owe $10,000. Market could completely crash. Doesn't matter. We owe $10,000. But let's say if the index comes all the way down to 1200. I know it would be incredibly unlikely, but I'm just showing what could happen. So we say, well, I'm going to exercise my 1200. When we go to exercise, though, it's worthless. We can't get the $20,000 out of it in order to satisfy the $10,000 obligation. And so this is something you have to be careful of when you're dealing with American style, which means they can be exercised early, and on a cash-settled index. And this is why professional traders, when they're doing vertical spreads, will almost always trade the XEO, which is just the letters of the OEX backwards, and that is a European style. It can only be exercised at expiration. So once again, I hope that shows that even on a fairly simple strategy, you can end up with things that might appear to be risks that aren't, and you might be in something that seems to be riskless when it really isn't. But in order to do that, and in order to know how to get your way out of it, you need to understand the art and science of options trading. And for anybody who'd like to learn more about the art and science of options trading, please check out our Facebook trading group, Options A to Z. It's a completely free site. We'd love to have you join.